Well, as promised, Fred Cannon is the director of research at KBW. Bloomberg Magazine rates his team #1 banking analyst group globally. That is very impressive, Fred. Good to have you on the show.
Great to be on, Adam.
All right. Insight and action, that's what we're all about, right? Bringing smart guys on and sharing your views. You have just upped your view. Your team has just upped its view on the smaller regional banks. Why?
That's right, because we think they're in a sweet spot. They're under $50 billion in assets, so they get to avoid that stress test that the Fed's putting on the banks. What does that mean? That means this industry that is overcapitalized, highest capital in 70 years, but can't return capital if you're big, can if you're small. We expect 22% earnings growth in this group as we move forward, the ones that we like. We think they're going to be able to return capital, and they're going to be able to beat up those big guys who are preoccupied with things that are going on in Europe and elsewhere.
When you talk about returning capital, how do they do that?
Dividends, share repurchase, and deals. While we have yet to see the wave that we are expecting in the banking group, we think by the back half of the year we're going to start to see deals really pick up in this group. And historically, when deals start to pick up in any group in Wall Street, stocks go up.
Places a bit under the market. Some of the names, just so people understand, what Bryn Mawr, which is in Pennsylvania, Columbia.
Up in the Pacific Northwest, Great Bank has rolled up a lot of these FDIC things, is ready to roll up the rest of the Pacific Northwest. Bryn Mawr, good private bank, growing quickly. A lot of these aren't household names by any stretch, but that's also what's good about them.
Now, also help our viewers understand, when these banks make loans, they're keeping those loans on their balance sheets, right? They're not turning around and securitizing them or selling them. Is that right? Absolutely.
These are just your basic bank. They take deposits and make loans. It's all right there on the balance sheet for us to see. So we don't have the mysterious issues about CDS and counterparty risk and all those issues that people worry about, whether it's an MF that's a broker or it's the big banks.
And just to repeat, you say these banks are well capitalized. They don't need more money.
No, absolutely not. This industry is already at a historically high level since the Great Depression in terms of capital. The average level of capital is near 10% at these banks. And we're not talking about funny capital. We're talking about common tangible equity.
So if common equity is about 10%, in other words, they're levered 10 to 1, as opposed to a JP Morgan, a Goldman Sachs, et cetera, which are 14, 16, 17 to 1.
Exactly. Or how about some of those banks over in Europe?
And how much are they levered, just so we can have the comparison?
20 plus in many cases, especially based on that common equity component.
Is that true for even the Deutsche Banks, the Commerzbanks, the Credit Agricoles, the big guys?
It all depends how you look at it, but the short answer is yes. When you start to look at what they have at risk in terms of not just balance sheet, on balance sheet, but off balance sheet, you bet they're still very highly leveraged.
Real problem. All right, bringing it back to the U.S. So you like the smaller regional banks. Let's move up to slightly bigger, the regional banks. You know, a Fifth Third, a U.S. Bancorp, a Regions Financial. What do you think of that group?
Selectively, we like them. However, again, because they're in this group above $50 billion, where the Fed is making them keep enough capital in case we get 13% unemployment, the stock market goes in half, they just can't do with the capital what those smaller banks can do. So, yes, we like USB. It's one of our top picks, but still, that group's going to be tougher as a group than these smaller banks as we move into 2012.
Will this group lose market share to the smaller regionals that you just upgraded?
Selectively, absolutely, because remember, a big issue for these banks is who has the legacy assets, who still has to deal with all those pre-crisis issues, the Bank of America type of issues. These small regionals, 10 of those of the 12 have no real credit issues. They are on offense, 110% on offense, so they're going to be able to go up against whether it's Bank of America or Fifth Third and pick up market share.
So who are the ones that still have issues? The two of the 12.
We still have Private Bank on there, which is an interesting one. It's in Chicago. We think that we'll continue to get that turnaround. Remember, across the banking industry, it was that turnaround in credit that got these banks up off the floor. But now that's not the big issue. The real issue now is profitability.
And then the big banks, the ones everyone always talks about. We almost get sick and tired of talking about them because we hear about them every day. Bank of America, JP Morgan, Citi, et cetera. What's the view there?
The view is it's a tough environment for them. They're the ones that have Europe. Really, there's only 5 banks in the country that have significant European exposure, and it's those big global banks. Number one. Number two is...
By the way, how big is that exposure as a percentage of assets? 3%, 10%, 20%-ish?
Well, the short answer is we don't really know exactly because it depends on which exposure you're talking about. If you're talking about notional derivatives, it's many times the size of the balance sheet. When you start talking about net derivatives, it's much smaller. Again, these aren't terribly big issues for the U.S. banks relative to Europe, but still it's major exposure when we're talking about counterparty risk to some of those big European banks.
And, of course, all kinds of regulatory issues.